Hello and welcome back to the ROI Club, the private publication where I give you my best investment ideas and equity research. Today, I'm on the laptop, had some technical difficulties with the other computer, but we're going to get right into it. Prairiesky royalty, there will be a write-up in the Substack, and this is to serve in addition to the text for those of you who are more video and visually inclined with a bit of commentary. So disclaimer, nothing I say here is advice, guys. You know that. Please, you conduct your own due diligence. I'm not a financial advisor. I'm not anything to do with you and your personal situation. So you need to figure that out for yourself. I make no guarantees. Let's get into it. So Prairiesky Royalty, who are they? Another royalty company. Surprise, surprise. You guys who have followed me know why I like that business model so much. They are the largest private landowner in Canada, in fact, and they hold royalty interests over actually about 18.3 million acres in total. Privately, they own, I believe, around 9.7 million of those acres themselves outright, but they have interests in about 18.3 million acres. All managed by only 65 employees. They've got claims on nearly 25,000 barrels of oil equivalent per day in terms of the production that happens on their land. And these guys do absolutely none of that. They just lease their land out to the producers and claim royalties and lease fees. So it's a wonderful, wonderful, wonderful business model. They are listed in Canada on the TSX. So that's a consideration for some people. They pay a quarterly dividend, and the forward yield at the moment is 3.73, but they've been paying around about 4.5%. They pay it annualized, they pay it quarterly, and they've been able to grow that at about 4.67% per year. So very, very interesting income stock, given that they've got basically a clean balance sheet. They've been able to grow their reserves, which you'll see in a moment, grow how much of their cash flows they pay out to shareholders, which is wonderful, wonderful capital management. Here's a one-pager, okay? I've converted everything over to US dollars so that you can see their revenues all calculated in US dollars, and so just keeping it consistent. But just bear in mind, if you're looking on the TSX, it will obviously be quoted in Canadian dollars. Not too much to say here other than they've got no debt of which to speak. They've got wonderful, wonderful margins. Look at that gross margin, basically 100%. The return on invested capital, return on equity is very, very high, and they continue to appreciate the acreage, the production, and the cash flow per share. Here's an example, a visual example of that. So I've made this little graph here showing their reserves per share over the aggregate gain. So one is proved reserves and one is proven and probable. Okay, obviously the higher number there. It's heading in the right direction over time. So management are allocating their capital very well in this regard. At the same time, the amount to which their cash flows are being distributed to shareholders is also increasing, which is obviously very, very good. You're getting the best of both worlds, a growing reserve base and a growing share of the capital being distributed to you as a shareholder. Is a very basic sensitivity table using the gas price and using the oil price. So using a very, I would suggest conservative base case using gas prices. Gas prices are very low now, so using very conservative gas prices, that would suggest the company can do around about 490 million a year in revenue. If you were to have a free cash flow margin of around 70%, you're looking at around about a 7% free cash flow yield to enterprise value at the moment using very base case scenario. The thing about this table, it does not take into account natural gas liquids. So let's add them back into the mix here. A little more nameless, but let's use their realized sales from last quarter and let's put it all together into a barrel of oil equivalent. Their realized price per barrel of oil equivalent was around $68. And so if you put that into the mix and you make a small sensitivity table based on that and based on revenues, it's not unreasonable to suggest they might be closer to 600 million a year in terms of their revenues. And obviously then a greater percentage would drop to the bottom line in terms of free cash flow. Free cash and the dividends You would expect to have grown given what I showed you earlier, and that's exactly what has happened at quite a reasonable rate. And I think this chart in particular really zooms in and shows you why this model, I just keep coming back to it because you've got revenue growth, double digits, free cash flow growth, double digits. Your gross is your net, as my Uncle Rick would say. So here you've got a wonderful opportunity to not worry about so much of the expense column, not worry about so much of the potential for management to mess it up because of simply the economics of the underlying business model. So I'm going to be harping on about that until I'm blue in the face. Revenue and free cash flow growth over a tricky period of time. So the last 5 years, you had 2019, fairly ordinary environment for the commodity. You had COVID, which was obviously a disaster. Not only did cash flows not suffer, but they were actually able to grow higher over that period because management can allocate more capital, getting better bargains on their acreage, getting better bargains on their ability to expand the reserve base per share in a weaker commodity environment. You don't get to say the same thing generally about producers. What sort of multiples do these things go for? Well, if you look over the last 10 years, about 20 times free cash flow. It says 40 times EV to EBIT here, but that's really not a great metric for this type of company. Looking at the last 3 years, 13 and 17 times respectively in terms of what the market's willing to pay for free cash and what the market was willing to pay for EBIT when you average it out and just give it a very quick and dirty mean. Okay, if you look at the lows, 8 and 10, really I think is a very good buying opportunity for this type of company. So the multiples I use, a terminal multiple 14, 20, and 10 for the EBIT using the base case, the bull case, and the bear case. I put it all together here in a summary. If you believe what I've got here, if you believe the growth rates, if you like the discount rate of 10%, if you like the terminal multiples, all of which are subject to subjectivity, okay? So you're in charge as to what you think that is or isn't worth. And you put into a pretty basic probability scenario for each of those playing out. Discounting that back, you're looking at around about $32.60 is what the company could be worth roughly, looking out into the future today. And if you wanted to add a 2/3 margin of safety there, you'd be looking at $21.51 US. And so with the company trading at $19 US currently, that suggests that there's a decent proposition for value there over the longer term. And given the underlying operating model of the business, this has me eager to deploy some capital. So I am buying the stock. I'm long in my long-term wealth and in the Maverick Life income portfolio because of the balance sheet, because of management's ability to allocate capital and the regularity of which they'll pay the dividend. So that's why it has a place in both. It's a quality, predictable, asset-light inflation beneficiary, which is something I've been obsessing over recently. Not only that, it is growing its net asset value, and you get paid to wait. So I would love to build this up even to a max position, 7.5% target waiting for Prairiesky royalties. Obviously, do your own due diligence, guys, and I look forward to catching up with you in another episode shortly. Take care.